This is also my first time at this conference. Pleasure to be here, and I guess for that reason I will do a bit more general background on the CEFC before I get into sort of specifics and make the announcement about our new investment in this sector. So I'm going to cover an introduction to the CEFC, a bit on the energy from waste market potential that we see, talk about finance options and considerations, just as a bit of general background for people that don't come from the investment community, and finally go into some different case studies. In terms of the CEFC, we're a government-backed investment bank that works across the Australian economy to help grow Australia's clean energy sector. We were established in 2012, and under our legislation we have access to $2 billion each year for 5 years, up to a total of $10 billion. Of that, currently we have access to $8 billion. Now, it's not use it or lose it, so we have the ability to take the time to find the right projects and make those investments. We follow a typical commercial investment process in terms of an early stage gating process, a more detailed credit style review, and then legal documentation. In terms of how we structure internally and how we think about helping the Australian economy convert to clean energy, we structure under these three categories. Our role is to mobilise capital investment in renewable energy, low emissions technology and energy efficiency across all sectors of the economy. This includes supply chain and export projects, such as PEF and RDF projects or biofuel projects, where the fuel may be produced here but actually ultimately used overseas. We are a sector specialist. We take the time to learn about clean technologies and how they'll operate in each sector. And then because we are established with a public policy purpose, part of our job is then to share our knowledge and experience, particularly with the investment community, to attract them to these sectors to finance alongside CEFC. As you can see here, bioenergy in the waste sector is one of our priority areas, and as Amy mentioned, that's the area of CFC that I lead. Within this sector, our focus is on technologies that are commercially proven at the proposed scale with the proposed feedstock. So for those that were here for Matt's presentation from ARENA earlier, and he put up the different development stages, obviously ARENA at an earlier stage, whereas CFC is focused on the commercial deployment of proven technologies. We're not about taking a primary technology risk position. This is the current state of our investment portfolio at the end of February. It also shows the year-on-year growth. At the end of February, we had investment commitments of $2.5 billion, net of repayments and cancellations, which represents growth of over 100% from June 2015. We have also recently exceeded $1 billion of deployed funds. So the commitments is contracts, whereas the deployed is money actually out the door and working. Again, net of repayments and amortisations or prepaid amounts. Our portfolio is approximately 70% debt, 30% equity, and for every dollar that CEFC invests in our current portfolio has helped to catalyse over $1.85 from the private sector. So that's our preferred working model, side by side with the private sector. The funds we've deployed are earning a return well above the 5-year government bond rate, which is our cost of funds. So it's about investing in these sectors at a profit. Again, Matt mentioned earlier that a lot of ARENA's return comes from the knowledge and the knowledge sharing. We have an element of that, but our return also comes from dollars in the bank. In terms of market potential, and some of these figures were mentioned earlier, in late 2015 we launched a report on the Australian bioenergy and energy from waste market. We wanted to present the opportunity in dollar terms because it wasn't something that we could specifically find or access from another source. And we wanted to show the investment community the investment potential and the outcomes that can be achieved. We estimated that the bioenergy energy from waste opportunity to around 2020 is between $3.5 and $5 billion, potentially doubling the current level of installed capacity from these sectors. And this first report focused on three areas: the urban waste industry, the intensive livestock or food processing with a bit more of a focus on anaerobic digestion, and then also plantation forest residues. As a renewable energy sector, we have to keep in mind that this sector can produce baseload or dispatchable renewable energy, and that has a real value that's starting to be more recognised in the market. So that 800 megawatts has the generation potential 2 or 3 times the same amount of wind or solar. And in the right locations, in the right structures and policy environments, the economics are at least as strong as those other technologies. You can also see that the majority of these opportunities are in the urban waste and food processing sectors, which includes everything from your large-scale energy from waste incineration projects to the smaller scale anaerobic digestion. There are a number of proposed projects already in the market. We've heard about a number of those today, and if you add them all together, you start to get up towards these numbers. We produced a second market report in late 2016 looking at a state-by-state analysis and the different state regimes, not just from a levy perspective, but also in terms of approvals and feedstock aggregation, which are all key issues in terms of investment. Levy inconsistency is a key investment issue in this sector. As has been stated many times, a significant amount of waste moves from New South Wales to Queensland, and it effectively puts a cap on the gate fee that can be achieved in the New South Wales market for projects. The target audience of this report, again, was the investment community and policymakers to get them understand how these issues interplay from an investment perspective. And a lot of them don't, particularly the investment community, not necessarily all the policymakers, don't fully appreciate the dynamics of how these markets work, and if waste is available at a gate fee, you're likely to get it for your project, and need to sort of have some education on how to better understand the fundamentals. Drilling down to the individual project level, in terms of how the CFC invests, we do this through three channels. Is it either debt directly ourselves if the project is large enough? That can be a corporate loan to a balance sheet or project finance on a standalone basis. Equity, and we've established a specific fund in this space that I'll talk about a bit more later. And then also through aggregation partners, which are more for the smaller projects where we work with parties such as the major banks listed here, and then they offer the capital to the market. And when we're talking smaller projects, effectively, from our perspective, that's sort of sub $10 million if they're looking for debt. Joyanne went through a number of these factors, and I guess this summarises them on a slide. And some of the things we consider looking at whether a project is bankable and how developed it is against each of these factors at any point in time. Technology, as I mentioned, proven technology, proven scale, proven feedstock is our starting point for everything. Feedstock, is it a merchant project, for example, a C&I, C&D project where it's very difficult to get a long-term fixed price contract, or is it a MSW project where there might be a 20-year council waste supply agreement from one council or multiple councils? Obviously, in some parts of Australia, aggregating that volume can be a challenge. And from an investment perspective, if there's 20 councils providing the waste, we go through and look at every different council, and you have to think about the scenarios about amalgamations. They obviously happen. What happens to the waste supply agreement then, for example? What if a council happened to go insolvent? It does happen. And as an investor, we need to understand the different scenarios. Obviously, the offtake, depending on what product is being produced. Is it electricity? Is it heat? Are large-scale generation certificates or renewable energy certificates being produced? And if so, how does that work in terms of that offtake contract? Where's equity coming from? How is construction risk being managed? Typically, particularly on a project finance basis, investors will look to see a fixed price, fixed time construction contract from a party with a big enough balance sheet to support that. And then operations and maintenance. Where does that risk set? Is it contracted out to a third party under a long-term contract, fixed price? Or is it a risk that sits within the business itself or the company that is running the facility, and therefore that could vary over time and impact returns? In terms of some of the challenges of investing in this sector, and I think it's worth being open about these, these are challenges to the overall sector, but also to individual projects reaching financial close. From an investment point of view, many energy from waste projects are assessed by the same team within the investment community as solar and wind projects, and also often the same team as toll roads and airports. In that context, bioenergy and energy from waste projects are materially more complex, have more moving parts, different technologies and different feedstock issues than those projects. The limited number of successful projects in the Australian market is also another issue. It means that there's limited EPC and O&M experience, as well as track record. Generally, we've also seen smaller scale project developers that don't necessarily have the experience or the capital to push a project all the way to financial close. And it also can impact the confidence of other parties that need to be part of an individual project to work with them in the first instance and dedicate the time and the resource themselves to working with a small developer. Approval processes are still relatively immature in the Australian market for energy from waste. And finally, as I mentioned, levy inconsistency is an issue. We are optimistic, however, that these issues can be addressed primarily through successful projects and ultimately a portfolio of successful projects. This builds the supply chain, it builds the confidence throughout the community, throughout the policymakers, and also through the investment community, which attracts more capital. As mentioned earlier, I'm very pleased to announce today a new CFC investment in this sector. The CFC is working with leading resource recovery company, Resource Co, to deliver an innovative alternative fuel plant in New South Wales. The CFC is lending $30 million to Resource Co to build 2 new plants that will transform selected non-recyclable waste streams into solid fuel, known as process engineered fuel. The first plant will be built in Sydney and a second in another Australian location yet to be announced. PEF is used in cement kilns, reducing the reliance on coal and other fossil fuels. This fuel will initially be used locally, but will also be exported as an alternative to coal and gas in cement kilns in Asia. PEF demonstrates the incredible potential to transform waste that would otherwise go to landfill into a baseload energy source as part of Australia's future clean energy mix, while also lowering emissions. When operational, the Sydney plant will process around 150,000 tonnes of waste a year to produce PEF and recover other commodities such as metal, clean timber and inert materials. As an indication of the plant's environmental credentials, it has been successful, as previously announced, in securing a $5 million grant from the New South Wales Environmental Trust under the Waste Less Recycle More initiative, and it's also eligible for ACCUs. The investment is expected to abate over 8 million tonnes of CO2 equivalent over the expected lifetime of the equipment. And there is more information on this project now available on our website. In terms of previous investments, as I mentioned, we do have an equity fund that we've invested in this space. So we've invested $100 million in an equity fund to be managed by Foresight. Foresight is a leading independent infrastructure and private equity investment manager established in 1984. Within their portfolio, Foresight have invested over 1.9 billion Australian dollars in energy from waste and bioenergy projects across 30 projects in the UK. We've identified them as a leader in this space and brought them to Australia to help manage our capital and invest equity in these opportunities. The Bioenergy Fund targets equity investments in the range of $2 million to $100 million, and it's a commercial fund with an appropriate target rate of return. Another project I wanted to mention briefly that some of you may be aware of is the Richboro Project. So this is an anaerobic digestion facility in Perth. You might know Richboro as the fertiliser company that you see in Bunnings. As you walk down the aisle, there'll be a number of bags there. So they invested in this facility a number of years ago. It's fully operational now and operating very well. So it's around a 50,000 tonne per annum anaerobic digestion facility with 2 megawatts of generation on the back end. In terms of their revenue streams, they obviously get paid for the waste at the front end, and their focus is pre-consumer food waste, so supermarket green waste, out-of-date soft drinks and chips and things of that nature, bakery waste. They then process that into their facility. They generate the biogas, they generate electricity from that, they use the electricity behind the meter, which reduces the cost of operating their compost business. They have excess electricity to export to the grid, for which they get paid as well. They also generate large-scale generation certificates, or LGCs, that they're able to sell and monetise at the moment at very good prices, well above when the project was banked. And they also produce a digestate from the anaerobic digestion facility that they can also use in their fertiliser. So a great project and one we were proud to be a debt investor in, now operating very well in the Perth market. If you're over there, I encourage you to go and have a look. And the last project I wanted to mention, because it may be relevant to some in the room, is CFC's previously announced as well a $10 million corporate loan to landfill gas industries. So that's allowed landfill gas industries to deploy a number of generators across council-owned landfill sites where they previously had flaring and they've been able to install a typical generator. So not a particularly innovative technology, I'm the first to admit, but we've accelerated their rollout of generators in that space and the generation of renewable energy. Again, revenue streams importantly from ACCUs through the ERF process, as well as the black electricity and the green certificates, or the LGCs, that they produce. So just to sum up, I guess, we see significant investment opportunities in this sector with strong returns. Understand, if you're developing a project, how investors will look at that project, the different factors they'll consider, and also the projects you're effectively competing with for capital, so what you need to demonstrate above that. Successful projects are absolutely critical to the development of the industry. Initially, obviously, a few successful projects, and ultimately a large portfolio that we can all point to. And finally, we're very happy to talk to anyone, even at an early stage, and provide general guidance on what you're going to need to do to get to a point that you're investment ready, either for us or someone in the private sector. So thank you, and happy to take any questions.